Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss the side effects of stimulus and volume of treasuries flooding the market. Phil, we've been talking about rates and inflation for the past few weeks and how that is impacting stocks. It appears that rates are backing off a bit, and we got some new inflation data this morning.
Yes. So obviously the 10-year bond rate's gone up pretty quickly. It's gone up from about 0.6 to 1.6 in the space of 12 odd months, or less than 12 months. And that has affected the valuations, especially of growth stocks. It's one of the reasons why the Nasdaq 100 recently hit correction territory. But yesterday we saw that all reverse. We saw the growth stocks and the tech stocks outperforming, best day in a couple of months. And that's also tied with the fact that rates started to come down. And I think reading what's going on in the market, a few people think maybe the rates have overreacted, at least in the short term. And that's kind of supported by the data this morning on inflation. So a lot of the forward-looking data, a lot of the producer prices paid data looks like companies are seeing increased input costs, expecting to raise their prices. But the CPI this morning was pretty muted. It came in at 1.7% annualized, and that's nowhere near enough for the Fed to get stressed about their 2% average inflation target.
Let's discuss the side effects of stimulus and the supply of treasuries now flooding the market.
Yeah, I mean, one of the good news items, I guess, today is the fact that the stimulus bill should pass. That's $1.9 trillion. It's a huge number coming into the system, which of course has to be financed. And so we're talking about rates rising because of potential inflation, but really you could almost reverse engineer another reason for rates rising is just the supply of treasuries is going to increase so much. And a few people have started to talk about that now as well. With so much supply of treasuries, you would expect prices to go down. And when prices of bonds go down, rates go up as well. So it's another argument for rates potentially being higher into the future. And obviously, we've had a huge amount of fiscal stimulus last year into this year. That's going to increase the supply of treasuries.
And Phil, to wrap up here, economists expect the stimulus and vaccine rollout to push the economy to its fastest annual growth in 4 decades. I would imagine the market wants to see not too hot and not too cold, and anything else will cause it to have a tantrum.
And you're absolutely right. So some of the latest forecasts of GDP are pretty exaggerated. There's a couple of charts out today showing economists expect GDP to grow at almost 6% this year, which we haven't seen since the 80s. It's a really strong rate of growth. And so the risk is, to your point, if you overheat the economy, you create too much demand, demand will push prices up, and that's when we get inflation. And when we get inflation, interest rates should theoretically catch up, at least to slow the economy back down, to make it easier to hire people, to slow the wealth transfer that happens with inflation down. So you're absolutely right. We've got to a point, I think, where if we see really positive data on the economic front, it might not be great for stocks. If we see really weak data on the economic front, it's not good for stocks usually either. So we do kind of want that nice sweet spot in the middle, don't we? Where the vaccines are rolling out, people are coming back to the market, but we don't see an overheating of the economy.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.